So, good afternoon to everyone, and welcome to the monthly Eurosif Sustainable Finance Update. So, as always, thank you for taking the time to join us today. During this month's session, we'll provide you with an update of the most recent regulatory developments in the area of sustainable finance in the EU and beyond. So with that said, let's take a quick look at our agenda for this afternoon on the next slide. Today, we're going to provide you with an overview of the FCA's recent proposals for a product labeling regime under the UK's SDR regime, which is, of course, a close relation to the EU's SFDR. Then we will give an update on the state of play of the Corporate Sustainability Due Diligence Directive, or CS-DDD, as it's referred to. And the CS-DDD is arguably the piece of legislation that has preoccupied people most in recent weeks. So we'll give you an outline of where it is in the legislative process and what the substance of the discussion has been thus far. Then we'll follow that with a quick update on the call for applications for the next iteration of the Platform on Sustainable Finance, or the Platform 2.0, as it's referred to, and also the two most recent reports of the outgoing platform. Finally, and really just for your information, we will briefly touch upon the European Banking Authority's recent report on the integration of ESG risks in the supervision of investment firms, and also the ESMA call for evidence on certain provisions of the Shareholder Rights Directive, or the SRD2. So as always, throughout the update, we would welcome any questions that you might have. If there's no possibility to answer on this occasion, please feel free to contact us after the session, and we will be happy to respond, assuming we have capacity. Of course, this video will be made available on our YouTube channel, and the slides used should be available in the description of the video if you want to revisit them at a later stage or share them with colleagues or contacts. So with all of that said, we can move on to the next slide and dive into our first agenda item. So on the 25th of October, the UK's Financial Conduct Authority, or FCA, published a much anticipated consultation paper on SDR disclosures and a set of potential labels for sustainable investment products. So the consultation elaborates a number of proposals for a future product labeling regime in the UK, which would complement the disclosures envisaged by the SDR, which is, of course, the UK's onshored version of SFDR, but which the UK, since Brexit, now has the chance to adapt to the needs of its domestic market and make adjustments to. So these labels for sustainable investment products are, of course, one of the adjustments that the FCA envisages and is proposing. Now, the FCA's primary motivation for proposing labels for sustainable investment products is to essentially facilitate retail investors in navigating the market and understanding what it is that different sustainable investment products are actually seeking to do. And then, of course, what they actually achieve in terms of sustainability outcomes. So in that spirit, the product labeling regime envisaged by the FCA appears quite simple. That said, conceptually, the FCA has developed quite sound foundations for the labeling regime. So, for instance, fundamentally, the FCA differentiates sustainable investment products from standard products, say with only a financial objective or emphasis, based on first their intentionality. So that is whether they have an explicit environmental and/or social objective. And then also how the firm makes a contribution to a positive outcome. In other words, the mechanism through which the firm offering the product encourages an improvement in the ESG performance of assets, of investee companies, etc. Or to use the FCA's term, the sustainability profile of an investee company or its assets. Now, interestingly, again, when it comes to the conceptual foundations of the FCA's proposals, they make a clear distinction between what they call enterprise contribution and investor contribution to sustainability outcomes. So enterprise contribution is anything a company or issuer does that improves their ESG performance or contributes to a positive environmental and social outcome. And more specifically, enterprise contribution refers to anything that they do independently, say, of an external influence. Investor contribution, on the other hand, refers to what financial institutions or investors can do to encourage investee companies to improve their ESG performance or contribute to positive sustainability outcomes. So the FCA recognizes three mechanisms or channels for investor contribution. And these are active stewardship and engagement, influencing the price of assets and the cost of capital by, of course, investing in certain assets and excluding others. And then three, financing underserved segments of the market. Now, in the FCA's view, these three mechanisms are how investors actually exert influence in the context of sustainable finance. In very simple terms, it's actually what investors can do directly. And for the purpose of the product labels, investment firms must be able to demonstrate that they have done one or more of the above, or are using one or more of the above mechanisms to achieve a certain outcome. Firms must also be able to evidence the positive outcomes that their influence has resulted in. However, that said, the FCA does acknowledge that such outcomes cannot be guaranteed by investors, and it can also be difficult to evidence them. So there is sort of an element of realism in the FCA's approach here. It's very pragmatic in that respect. Now, if we move on to the next slide, with the conceptual background sort of established, I can briefly present the labels for sustainable investment products that the FCA has in mind. So three labels have been proposed: sustainable focus, sustainable improvers, and sustainable impact. Now, importantly, in order to apply one of these labels to your product, you must satisfy the qualifying criteria envisaged by the FCA, which we'll cover in a moment. Also, the labels are mutually exclusive, meaning you can only apply one of them to a product. There cannot be overlap. A product cannot in part be sustainable focus and in another part be sustainable improver. They are mutually exclusive. Now, perhaps most significantly, unless you apply one of these labels, you will not be able to market or describe your product as ESG, green, and/or sustainable in any way. The FCA has a list of terms that will be prohibited when it comes to describing your product unless you apply one of these labels and your product satisfies the qualifying criteria. Also, use of these labels must be accompanied by consumer-facing disclosures that are comprehensible to retail investors. The FCA has set out requirements for those disclosures in its consultation paper. Now, there is something the FCA acknowledges, and that is that there will be products with ESG features or characteristics that are integral to its design or strategy, but which do not qualify for use of one of these labels. And what's interesting is, of course, that is not prohibited. You know, of course, products and investment firms are encouraged to pursue varying degrees of ESG ambition in their strategy. However, if they are not eligible for use of one of these labels, they still have to make disclosures that are proportionate to their sustainability features. So that is sort of something that the FCA has done, I suppose, to ensure transparency in the market, but also allow for still a bit of variation in terms of products. They don't all have to adhere to the standards that underpin these three labels. So we can move on to the next slide and describe a bit now, you know, how it is that products are eligible for these labels. So maybe first starting with sustainable focus. To be eligible for a sustainable focus label, a product must have as its objective to maintain a high standard of sustainability in the profile of the assets by investing to meet a credible standard of environmental and or social sustainability, or align with specific sustainability themes. I suppose in simple terms there, what it means is the product must invest in assets that already in a way qualify as sustainable. When the FCA says, you know, a high standard of sustainability in the profile of the assets, I think effectively what they're saying is that the assets must already have a high ESG performance or strong ESG credentials. Moving on to the Sustainable Improvers label. To be eligible for a Sustainable Improvers label, a product must have the objective to deliver measurable improvements in the sustainability profile of assets over time. These products invest in assets that, while not currently sustainable, have the potential to be. Then, of course, turning to the third and last label, the Sustainable Impact label, to be eligible for use of this label, a product must have the explicit objective to achieve a positive, measurable contribution to sustainable outcomes. These are invested in assets that provide solutions to environmental or social problems. So with that, we can move to the next slide and discuss some of the qualifying criteria. And of course, I can clarify further, you know, some of these labels at a later point. But in terms of the qualifying criteria, there are 5 general criteria common to all of the labels. And then these are adapted or supplemented by label-specific requirements. So the general qualifying criteria that all products applying one of these labels must satisfy are: 1, they must have a clear sustainability objective. And this is where intentionality comes in as a defining feature of a sustainable investment product. 2, there must be an investment policy and strategy consistent with the objective. 3, there must be KPIs in place to assess the product's performance from a sustainability standpoint. And 4, resources and governance must be adequate to administer and assess the product's performance over time. And 5, the firm must exercise stewardship in a manner consistent with the objectives of its sustainable investment products. Now, those are the general requirements, but they are adapted then to be label specific in some instances. So for instance, to qualify for a sustainable focus label, a product must have 70% of its assets meeting what the FCA refers to as a credible standard of sustainability. Now, the FCA has not prescribed what a credible standard of sustainability is. Instead, they've said it has to be consistent with what the average consumer might reasonably expect in terms of environmental or social sustainability. So that again is the FCA standard is reasonable expectation of a consumer. They have very explicitly shied away from being too prescriptive in this consultation or in proposing these standards. Also, of course, for an asset to be considered as meeting a credible standard of sustainability, it has to be independently assessed. Claims have to be evidence-based and transparent. So maybe just for those of you that are prone, as I am, to comparing what the FCA proposes to the product categories in SFDR, products that apply the sustainable focus label in some ways correspond to Article 9 products, in that an asset meeting a credible standard of sustainability sounds quite a lot like a sustainable investment as defined by Article 217 of SFDR. Now, moving on, to qualify for a sustainable improvers label, a product must have a clearly elaborated engagement and stewardship plan, a clear means of demonstrating the transition potential of the assets invested in, and a set of KPIs for how the sustainability profile of assets are expected to improve over time. However, otherwise, there's no real restriction in terms of what a sustainable improvers product can invest in. Finally, to qualify for a sustainable impact label, a product must be able to clearly demonstrate that it is financing solutions to environmental and social challenges according to a well-articulated theory of change. Now, I think I need to perhaps revisit what the FCA envisages with a sustainable impact product, because it's still not entirely clear to me to what a solution is and what a well-articulated theory of change is. Now, incidentally, and finally, just as no products that do not qualify for the labels I've just described are permitted to promote themselves as ESG sustainable or green unless they apply one of these labels, only products applying the sustainable impact label can use the term impact when describing themselves. So unless in the UK context you'll apply this label, you will not be able to say your fund is an impact fund. And unless you apply the other labels, sustainable focus or sustainable improvers, you will not be able to say you're ESG, you're green, you're sustainable. So that's, I think that's worth repeating just because it is significant. Now, moving on to the next slide, and I promise this part of the update is now over. The FCA is, of course, consulting on these proposals. The consultation will remain open until the 25th of January, 2023. It intends to issue a policy statement by 30th June 2023 outlining the final rules. And then, of course, the rules concerning the use of sustainable product labels will apply as of 30th June 2024. So there's quite a generous implementation timeframe envisaged by the FCA. So with that, that concludes the update on the FCA proposals with respect to investment labels. We can now move on to our next agenda item, and I will pass over to my colleague, Federica. So please, Federica, go ahead.
Thank you, Hugo. So today we want to provide you with a brief update on the Corporate Sustainability Due Diligence Directive, because the file is moving up among the EU political priorities of the Czech presidency, and also because the file has profound consequences for financial institutions, and we will see it in a bit. So just as a background, the EU Commission proposal for a directive on due diligence was published on the 23rd of February. And following multiple prior delays, and after having received 2 negative opinions of the Regulatory Scrutiny Board, which gives a sense of the extent to which the file is considered as contentious. So in terms of scope, the directive applies to companies established in the EU or operating in the EU, or better, that generate certain amount of turnover in the EU. It applies to companies with more than 500 employees and a net turnover exceeding 150 million euros, or to companies with more than 250 employees, a net turnover exceeding 40 millions, if 50%, at least 50% of this turnover is generated in certain high-risk sectors, which are textile, agriculture and food, and minerals. So the directive introduces a number of obligations for financial and non-financial companies, including obligations regarding the due diligence on environmental and human rights adverse impacts. In particular, the due diligence must cover actual or potential adverse impacts. It implies identifying adverse impact, preventing and mitigating the potential impacts, and bringing actual adverse impact to an end. Moreover, companies must monitor the effectiveness of their due diligence. They must publicly communicate on their due diligence policies and practices, and introduce complaints procedures for those that are affected by the adverse impact. Importantly, the directive requires companies to adopt a transition plan in line with the objective of limiting global warming to 1.5 degrees as set in the Paris Agreement. And looking at how the text is formulated now, companies must adopt emission reduction targets if climate change is considered as a risk or adverse impact for the company. Then, if the company has variable remunerations for director linked to sustainability, the achievement of the objectives set in the transition plan should be considered in those variable remunerations. Just other key points, the directive also introduces the director's duty of care, meaning that directors must take into account the consequences of their decisions for sustainability matters. And the directive introduces civil liabilities for companies that fail to comply with obligations on due diligence, and when an impact that should have been identified, prevented, mitigated, or brought to an end causes damage. So it's a directive, so member states will have to introduce national laws to ensure that those obligations are enforced and those objectives are achieved. So we can move to the next slides. So what's in for financial institutions? So on the due diligence, there are some exemptions for financial institutions. Specifically, the obligation to conduct due diligence is limited to a pre-service assessment. What does it mean? When financial institutions in the scope provide credit, loan, or other financial services, the identification of actual and potential adverse impacts must be carried out only before providing the service. And this pre-service assessment only considers the activities of the clients receiving the investments, not all the value chain. Furthermore, for financial institutions, the definition of value chain, in this case, does not include SMEs which receive loans, credits, and other financial services. So on this regard, I want to underline that financial institutions are indeed already covered by some sector-specific EU legislations regarding due diligence, and in particular by SFDR, which contains disclosures requirements, and the operations affected are investment activities, and the due diligence applied to investment decisions, whereas in the CSDDD or CSDDD, the due diligence is required to own operations of subsidiaries and established business relationships. And the other sector-specific EU legislation, which covers due diligence for financial institutions, are the delegated acts of UCITS and the AIBD, because they introduce some degree of obligations regarding due diligence, and in particular, investors must integrate processes to identify sustainability risk in their investment and risk management, governance, and control. So the complexity of the issue here, or better, one of the dimensions of the complexity, refers to the fact that due diligence actions that can be undertaken regarding the value chain differ between companies and investors or asset managers. And there is a need to formulate provisions that are implementable also by financial institutions. And there is also, of course, a need for alignment between what is mandated in the EU laws, in this case on the CSDDD, and how due diligence is considered in the already existing international standards of the United Nations and also the OECD guidelines, which are widely adopted. So with that, we can move to the next slide to have a look at the state of play in Brussels at the moment. So the file is following an ordinary legislative procedure, meaning that the EU Council, representing member states, and the EU Parliament, articulated in the various committees, are in the process of discussing internally to achieve a respective position on the EU Commission proposal. Once the EU Council and the Parliament have their final positions, they will go into interinstitutional negotiations, the so-called trilogue. So what is the state of play now? So in the Parliament, the committee responsible for the file is the Committee on Legal Affairs, normally referred to as jury. And many other committees are providing opinions on specific aspects. For instance, among the committees involved, we have the ENVI on environmental affairs and ECON on economic and financial affairs. So at the moment, all the various committees are working on drafting and agreeing their own opinions with amendments specifically to the text of the Commission. And at a later stage, those opinions will feed into the process of agreeing with URI, which is the leading committee. So which is the timeline for the URI committee? In the next few days, the committee is expected to publish the draft reports, which will be discussed and considered on the 17th of November. The deadline for presenting amendments to this draft report is the 30th of November, so the end of this month. And all these amendments will be considered and discussed throughout the winter. So the vote of the URI position is expected for March 2023. So other committees now have already published their reports, are accepting, considering, or discussing amendments. So it's a kind of work in progress in the Parliament. In the EU Council, so from person very close to the negotiation, we've heard that Czech presidency is determined to speed up the process and aims to have the general approach, so the council position agreed at the political level by member states, approved in December. So the Working Party on Company Law, which is the preparatory body that is discussing the file, is expected to meet and discuss the CSDDD on the 7th and 8th of November, so next week, and then at the beginning of December. And we can move to the next slide, which is the last one on this topic. What is being discussed? Very briefly, because the topics discussed are many. So just to provide a brief overview. Generally speaking, the Parliament tends to adopt more progressive stances. So we are hearing that in various committees, there are calls to tighten, for instance, the requirements for the financial sectors. Notably, for instance, in the draft report of the ECON, there is a call for inclusion of the financial sector in the list of high-risk sectors. And there is also a proposal to remove some of the exemptions that were included in the first proposal of the EU Commission for the financial institutions, and which we covered just some minutes ago. There are also instances regarding the strengthening of the link between the director variable remunerations and sustainability. However, there are other parties from center or right in the various committees that are underlining the increased burden for the SMEs that, of course, will be captured by the obligations. Some of the topics that are discussed in the Council, but not only in the Council, are, for instance, the scope. So many positions also from civil society organizations and industry representatives highlight the need to broaden the scope of the CSDDD to align it with the CSRD. So ideally, the CSDDD should introduce certain obligations, whereas the CSRD, which has already finished its legislative procedure, introduced the requirement to disclose on those obligations. So there should be a discrete level of coherence, of alignment in the scope between the two legislations. There are discussions on the thresholds, whether it is a case to lower or raise the thresholds, and discussion as to whether to include or not to include at all financial institutions. Another topic for debate is the definition of value chain. So member states are discussing as to whether it is the case to change the definition of the value chain and better replacing it with supply chain, meaning that only upstream part of the value chain is considered. And there are also some other options that are proposed and debated. The term established business relations is also debated, and it is one of the parts that forms or constitute the dimension over which companies are required to conduct the due diligence. So it is very important. Another contentious point is the director's duties. Many member states are opposing this article, partially because they have successfully introduced their own national schemes. And finally, of course, the role of financial institutions is highly debated. There are some NGOs, investor organizations, parts of the industry, and representatives also among co-legislators that advocate for introducing ongoing assessment covering the entire value chain and possibly accompanied by guidance clarifying how different financial companies should interpret their responsibilities. On the other side, there are representations from the industry and representatives among co-legislators that are proposing a sector-based approach for the due diligence, so specific rules for financial institutions. In some other instances, there are other parties advocating for a total exemptions for financial institutions. So as said, this is a very contentious file, and it has profound consequences on financial institutions. So this is very important debate for the industry at the moment. So if we can move on to the next slide, I would just want to briefly provide an update on the platform on sustainable finance, very briefly. As we know, the platform is a permanent multi-stakeholder expert group that is assisting the Commission in developing the taxonomy and other sustainable finance policies. The role of the platform, by the way, is set in the taxonomy regulation. So first of all, the EU Commission is selecting new members of the platform on sustainable finance as it approaches its second mandate from first quarter of next year until the end of 2024. The platform current mandate has ended in last month, so in October 2022. So from what we learned from the communication of the Commission, the new platform will be divided into subgroups, focusing on 3 priorities: the usability of the taxonomy and the wider sustainable finance framework, the development of additional technical screening criteria for the taxonomy and possible revisions of the existing criteria, and monitoring of capital flows into sustainable investments. So for those of you that are interested, the call of application will be open until the 9th of November at 12. So you can find all the information regarding the call for application and also the procedure to send your application on the EU Commission website and in the section dedicated to the platform. And finally, and very, very briefly, on the 11th of October, the platform published 2 reports. One about, one contains the final guidelines on minimum social safeguards. As we know that there was also an interim report and then a consultation process. And finally, the platform issued also a data and usability on the taxonomy report. So with that said, I will give the floor back to my colleague Hugo for the next parts of the agenda for today's afternoon. Thank you.
Many thanks for that very comprehensive overview, Federica. So this will also be very brief. Largely just our 2 remaining items on the agenda are for information purposes. There's no intention for us to go into depth. Nevertheless, interesting developments for you to be aware of. So first, on the 24th of October, the European Banking Authority, or the EBA, published a report on the integration of ESG risks in the supervision of investment firms. So just to be clear, this report is really more addressed to national competent authorities, and it provides instruction or guidance as to how NCAs should integrate consideration of investment firms' exposure to ESG risks in the supervisory review and evaluation process. So of course, the requirements for the supervisory review and evaluation process, the SREP process, are set out in the investment firm directive and the investment firm regulation that set out the prudential framework for investment firms. And given that there's been an increasing recognition in the supervisory community that ESG factors can be material for the exposure that investment firms have to various financial risks, increasingly there's a desire on the part of the EBA and NCAs to integrate consideration of ESG risks in the supervision of investment firms, and to try and assess to what extent investment firms are exposed to material ESG risks. So what's probably most striking in the report, and again, I won't go into detail, is just that the EBA acknowledges the challenges associated with assessing investment firms' ESG risk exposure for NCAs, not least when it comes to data constraints, which are affecting nearly everyone at this point. So accordingly, in view of some of these challenges, and the need for NCAs to build up capacity, the EBA effectively instructs NCAs to introduce consideration of ESG risks in the supervision of investment firms only gradually. They stress the need to respect the principle of proportionality. So of course, NCAs should not maybe be quite so rigorous when it comes to supervising smaller investment firms, and they should always take a risk-based approach, only focusing on where they see a clear prospect of a risk arising. And then of course, largely linked to data constraints, NCAs should prioritize assessment of climate and environment related risks to the capital of investment firms. So that is very quickly just sort of an overview of the EBA report. It is sometimes important to remember that the EBA does have some competences over the supervision or setting of standards for the supervision of investment firms. It's not always ESMA, so this sort of thing can easily get missed. But that concludes that. Quickly moving on to the next slide and the very last item on our agenda. On 11th of October, ESMA published a call for evidence concerning the application of certain provisions of the Shareholder Rights Directive, or the SRD2. Namely, ESMA is seeking to understand whether SRD2's provisions on the identification of shareholders, transmission of information from corporates or investee companies through to shareholders, facilitation of the exercise of shareholder rights, and transparency of proxy advisors have been effective. Now, this call for evidence is largely addressed to investors, proxy advisors, companies, etc. It is open until the 28th of November, and it will feed into a report that the European Commission is preparing on whether to revisit aspects of the SRD2 framework and review them in future. So that is largely the wider context. So with that, I think we have concluded our updates. There is maybe one final thing we can say, and that is that the SFDR delegated regulation, which outlines the detailed disclosure requirements that will apply as of 1st January 2023 and includes product disclosure templates, has just been amended to the adoption of a further delegated act to incorporate additional taxonomy-related disclosures to ensure transparency around exposure to natural gas and nuclear energy investments that comply with the technical screening criteria in the complementary delegated act. So, of course, maybe just a few words on this before we conclude. When proposing the additional disclosures to the Commission, the ESAs explicitly asked that the Commission, when adopting this delegated act, specify clearly from when these additional taxonomy-related disclosures would apply. Unfortunately, the Commission has not made that specification. And so there is now a debate as to when these disclosures will be required. My assumption is, and my feeling is, that in the absence of a statement to the contrary, it will be as of 1st January 2023 when these additional taxonomy-related disclosures apply. Now, those that are very keen-eyed among you will have noticed that, of course, this delegated act amending the SFDR delegated regulation has a feedback period of 3 months, which will extend past the date of 1st January 2023. Nevertheless, I think it's probably wise to assume that you'll have to make these disclosures from 1st January 2023. But with that said and out of the way, that concludes our session today. You will have to forgive us in that we did encounter technical issues today, or rather security issues with our YouTube channel. And so we are going to have to upload the recording of this session a bit later. We do apologize if you weren't able to follow the live stream, but of course, you still have access to the recording and to the slides. With that, I'll wish you a very good day and rest of the week. And we look forward, hopefully, to seeing you back in December. So many thanks and all the best.